Well, hello and a very warm welcome to this Scope Group webinar, Aircraft Lessors, taking a new tailor-made approach to rating credit and ESG in aviation finance. My name is Keith Mullin, and it's my pleasure to be your moderator in today's session. Delighted to be joined today by Dierk Brandenburg, Head of ESG and Credit Research, and Michel Graire, a Senior Analyst in Scope's Project Finance team. Now, in a moment, Dierk and Michel will take you through a presentation that will cover a number of areas: whether aircraft lessors should be assessed as finance companies in their own right or as a subsector of financial institutions, how crucial the individual characteristics of each aircraft in the fleet are, how ESG risks can be incorporated into credit assessment. They'll also give an outlook for the sector in 2022. Now, after the presentation, they'll be happy to take your questions, so please do use the Q&A function on the platform. So without further ado, it's my pleasure to hand over to Dierk. Dierk, good morning, good to see you. The floor is yours.
Thank you very much, Keith. Good morning, everybody. I shall be introducing the basic starting point of our methodology, and then my colleague Michel from the project finance team will go through the particular aspects on the asset and equipment analysis that we are doing as part of this methodology. I think the main point about this methodology is to offer a tailor-made approach to this sector. So we're intending to cover finance companies with this, and the real emphasis is here on finance companies that have equipment leases and that generate their cash flows from aircraft leasing operations. And that would then also include engines and other services they provide. Together with other methodologies we already have in place, particularly on the financial institution side, but also on the public finance side, we also able to then integrate leasing subsidiaries owned by banks and other types of corporates as well, and then most importantly also government-related entities, which are also present in the sector. What we're not covering is, with this particular methodology, would be the captives of actually OEM aircraft producers. That would be a part of sort of corporate analysis we would do on those corporate groups. The lessor industry, or the equipment lessor industry, sort of falls in a very peculiar part of the credit spectrum. So most credit rating agencies, they will have pretty refined methodologies on non-financial corporates, which you can see on the right, really focus on cash flow. And then we also have very extensive methodologies on financial institutions, especially banks, which are here on the left, where it's really all about capital and asset quality. And what I'm showing on this slide is essentially how equipment leasing sort of falls right into the middle between those two worlds. At Scope, we do cover finance companies, usually as part of our banks and financial institutions methodology. And that includes financial leasing. But for equipment leasing, given the fact that these are not lending products and usually they're unregulated entities, we felt it was necessary to split this out into a separate methodology. And given the focus here of our existing research, particularly on aviation industry, both in terms of airline operators, but also in terms of equipment finance, we thought we could offer a methodology here that very specifically focuses on the equipment leasing finance company sector, and then specifically on aircraft assets. That means that the starting point for this methodology is always the actual fleet, the actual assets owned by an aircraft leasing company, and we believe that this is ultimately the key credit driver, the quality of the equipment, the age, and so forth. All rating agencies today, and also investors, put an increasing emphasis on ESG. So we also integrated this, since this is a new methodology, right from the start into the actually analysis of the core franchise of any aircraft leasing companies. And we will expand on that further down in the methodology. And then another important point, which is particularly interesting in the current environment, again, is that in line with all the other analytical approaches we take across Scope's rating methodologies, we do not have mechanistic top-down credit caps on the jurisdiction either of the aircraft lessor or even of the clients of those aircraft lessors. The upfront analysis that goes in here, which is kind of a given because this is a specific methodology for aircraft lessors, is that we've made an assessment about the cyclicality of that industry, which we judge to be moderate. We made an analysis of the entry barriers, which is clearly driven by the very high capital needs to actually purchase and maintain aircraft and also build those relationships with clients. And then the question of substitution risk of the actual equipment. So the question, is there alternatives to air travel, which is clearly an issue that is coming on the screen here, but we still think those risks are currently low. To underline that, I think the one interesting point about aircraft lessors is the quite different economic performance here, particularly during the COVID crisis, which was kind of the real life stress test really for this industry. What we plotted here on the top left-hand side is the EBITDA of the main aircraft lessors, which took a knockdown during COVID, obviously. But if you compare it to the results of the actual operators on the bottom right-hand side, then you can see that their cash flows were a lot more resilient than that of their clients, given the structure of the leases they have. And also looking at the volatility and growth path of EBITDA of the industry, it is quite closely correlated with sort of general trends in the economy. The volatility in the sector really comes from asset valuations, and you can see that on the bottom left-hand side, and that's indeed where our equipment analysis kicks in to get that into the rating. Another interesting aspect of the industry is that it has been consolidating quite rapidly, notably with the merger of AerCap and GECAS last year. And so we're dealing with an industry which is actually quite concentrated. It is global, so you would expect there to be very large operators, but clearly the top five here, they concentrate at least 70% of the sector we can trace. And that also gives it, the industry, I think going forward, quite a good pricing discipline here. Before I hand it over to Michel, I'll just take you through the basic steps we're taking in analysis here. So as I said, we kick off with the fleet quality analysis, the client's analysis, and the competitive positioning of a leasing company, of an aircraft lessor, and that really forms what we call the anchor rating, and that really positions the credit sort of on a long-term structural basis. And then we carry out the financial analysis, very similar to what we carry out on corporates and financial institutions, which then gives you the cyclical element to the rating. And then on top of that, since this is quite a varied industry in terms of the corporate structures that are being used, and also in terms of the outside support that is available to some of the leasing companies, we carry out an additional structural leg where we look at the organizational setup and any potential external support we can factor into the rating. And then we also allow for a couple of qualitative adjustments to take account of special situations, for example, a merger or a change in management and so forth. All that leads us to a final rating. In line with our standard approach to credit ratings, we assign an issuer rating to each issuer, then typically a long-term debt rating, unsecured, and also in some cases where applicable, we also apply our corporate hybrid methodology for subordinated debt issued by the sector. With that, I hand it over to Michel to take you through the first elements of this methodology.
Yes, thank you very much, Dierk. So as it says, our analytical process includes 4 steps, and the first step is the anchor rating analysis. So, and this is what makes our methodology quite unique in the market. It is the fact that we start with an analysis of the asset of a lessor's fleet quality. So the first feature is the fleet quality, including 4 criteria: the aircraft model's age, the technology and phase in the life cycle of the lessor's fleet. Third one is the body type of aircraft, such as narrow bodies, wide bodies, regional aircraft, or cargo, for example. And the fourth criteria is the fleet diversification. How diversified is the lessor's fleet in terms of body types of aircraft? So this will be basically the first component. Second one is we will have a look at the airline client's probability of default and jurisdiction. We will assess every airline client of the lessor, and in the end, we will get a rated average 1-year PD for the fleet. And we will enhance this score with a jurisdictional risk score based on the average repossession time expected in case the airline is going bankrupt. The third feature is an assessment of the competitive position and ESG criteria. We can go to the next slide to have a more detailed view on that. So competitive positioning assessment includes the economies of scale, which is how able is a lessor to order large speculative orders and offer a wide range of different aircraft models to airline clients. How able is a lessor to offer capabilities in-house? Are aircraft engineers or pilots available in case of repossession and remarketing? Third one is the track record of lessors. How many years is the lessors operating in the market? What kind of experience with different aircraft models? And of course, market share. And as we saw previously, it's a quite concentrated market, even more now with the merger of GCAS and AirCap. So market share counts in the competitive positioning assessment. And ESG assessment is one of our highlights in this methodology. ESG, as you all know, is an increasing requirement from investors, from regulators, from other market participants. And we decided to integrate the ESG assessment directly in the credit risk analysis and not as a second opinion. So it will be directly incorporated in the credit risk analysis, and we will notch down or up regarding how ESG compliant is the lessor, breaking in three components: environment, social, governance, as you all pretty know. And at the end of this first step, we get an anchor rating, which will be enhanced by the financial analysis, which is the second step of the analytical process. And at this stage, I will hand over to Dierk.
Yeah, thank you very much, Michel. So pushing on from here, you can see on this slide that we have a three-step approach to the analysis of the financial metrics. A lot of the ratios here will look very familiar for people who are involved in corporate credit and also in bank credit. We have modeled this quite closely to our approach to the banking methodology or the financial institutions methodology that we already have in place for many years. I think one of the key points here is that we do not apply fixed metrics. So this is a relative peer group analysis we're carrying out, bearing in mind that we already have a starting point from the anchor rating on this. And we do go through the earnings and risk exposure first, then looking at financial viability, which is essentially leverage. And then we also have a separate leg of liquidity analysis, which is built very closely on the approach we already have in our corporate methodology. So these two steps show quite nicely how we intertwine here aspects of financial banks or finance company analysis in terms of focusing on return on assets and return on equity on one hand, and then in the financial valuability, we do put a lot of emphasis on the leverage ratio, but we also then include the classic corporate ratios, debt, EBITDA, interest, and free cash flow. So that puts the methodology sort of between the two worlds, but I think it's very important that on one hand, the market very closely follows the cash flow margins of these companies, but at the same time, particularly in times of crisis that we've seen both during COVID and maybe again now during the Russia events, that the equity cushion and the leverage of those companies and ultimately the underlying valuation of those assets play a key role for the credit profile. We did carry out a benchmarking going back the last 10 years to give us the relative positions of these companies. So I just sort of, for illustrative purposes, I put this on the slide here. So seeing there is quite a bit of granularity and also divergence of the various ratios between the companies. And that would serve as a starting point to any rating assessments. Obviously, any particular company, there would be a more detailed analysis of the data, and also there clearly that's all subject to a rating committee assessments ultimately. Another factor which I highlight at the start is that once we've analyzed the anchor rating and we also analyze the financial, basically the balance sheet or P&L strength of the company, there are often structural elements to the credit that are very important. A lot of companies, they encumber their assets, they use subsidiaries, they use structured finance instruments and so forth. So to the extent that this is present to a large number or encumbers a large part of the balance sheet, we would then analyze that and also include that in a rating adjustment based on a sort of dedicated structural analysis. So that's what we mean by organizational complexity here. And then there is the other leg, which is very similar to the approach we already have in place for financial institutions and public finance entities, which is the question of external support. So this could be affecting subsidiaries, could be affecting the direct guarantees they may have, the integration into parent companies, and then obviously also the less integrated aspects of those. So this can lead to rating adjustments sort of as another step next to the anchor rating, the financial analysis, and then this step. And then, like with all methodologies, we do have a qualitative adjustment possibility to basically reflect anything that we don't feel the previous steps have adequately captured. So we may make additional adjustments for transitory situations such as M&A, to management aspects, changes, and then also to unanticipated moves in corporate strategy and so forth. To summarize the whole methodology, we've included a sort of a mock-up rating sheet here. That's also part of the methodology. You can find it in the document where we just take you through sort of the baseline assessment for essentially an average aircraft lessor that scores average on all these factors we just mentioned. And you can sort of see how it flows through, with the fleet quality being the starting point, in this case benchmarked to a double B rating. Then we're adding on the sort of more nuanced aspects of airlines client score, which is obviously key in terms of the credit risk that lessors run, the jurisdictions they operate in, which is very key at the moment when we look, for example, at cases like Russia, their competitive position, and then an ESG adjustment, getting to the anchor rating that Michel already described. And then on the next page, it then just flows to the financial analysis. Again, an average earnings capacity, financial viability profile will then just affirm that view on the anchor rating, but it also can then clearly be notched up for companies that have above average earnings capacity or just lower leverage than peers. And then we also have the liquidity adjustment. The liquidity adjustment works slightly differently in the sense that this is more of a binary outcome. Either it does meet our requirements or it doesn't. And if it doesn't, then obviously the ratings will be notched down. There are possibilities where they could be notched up slightly in cases where there are sort of exceptional liquidity ratios, particularly for companies that are in the high yield initial assessment. They could receive an uplift here, which is in line with what we do in our corporate methodology as well. And then below that, we flow through to organizational complexity, which in normal circumstances would not lead to an adjustment, external support, and then down to the final issue rating after we made our qualitative adjustments. So that's in a nutshell how the approach works. And that would conclude the introduction of this call. So with that, Keith, I don't know, can you stay with me?
Sorry for the date. Yes, thank you very much for that, Dierk and Michel. So we'll go straight to some questions. So please, those of you who are watching this, please feel free to type your questions into the Q&A function and we'll take them. There is, in fact, there's a couple of questions already, which I can perhaps put to you, Michel, which is basically the following. How do you assess fleet net book value versus current market value? And the follow-up question is, what about cost income ratio? Can you handle those?
Yeah, of course. In terms of assessing the fleet book value, first in assessing the aircraft, I mean the current aircraft model's age and technology and phasing in the life cycle, you already get an assessment of the book value of the fleet. Another point is we have access to appraisers databases in terms of aircraft values. So we would constantly monitor, I mean, in assessing aircraft lessor's fleet, we will continuously monitor its fleet, definitely, and it could be a quantitative as a qualitative assessment.
Yeah, maybe I'd pitch in here because I think when we go back to the ratio question, this actually has an impact also on the financial analysis. And I think it's an excellent question because I think this is where our methodology is slightly different maybe from others. Given that we're only having aircraft lessors in this calibration, we basically did not put in a sort of residual analysis. And bearing in mind that in the anchor rating, we already have our assessment of the collateral, and we also have our assessment of the clients. So in a way, the question of where market values really matter is when the clients go, whatever, bankrupt or return the equipment, and at the same time, the value of those assets falls, which has clearly been an issue for the last couple of years. In fact, could be another issue this year. I think so that is already partly in the anchor rating. And since we're only covering aircraft lessors with this methodology, we actually think we can we already put quite an emphasis on that in that part of the analysis. The second aspect, which is very important, is the leverage ratio. So that is part of our financial viability assessment. And clearly, that is an assessment in the sense that we can look at the reported book value and then obviously the reported leverage ratio. But if we have reasons to believe there are valuation issues on that balance sheet, and having analyzed the collateral and obviously having access to the book values, we then would reflect that also in how we judge the leverage of that company. So I think it comes in those two aspects.
Okay, very good. Given the current situation, I mean, let's perhaps not get too much into the current situation in Russia, but events in Russia clearly play into the aircraft lessor sector. And so can I just ask that as just a general open question? How do the events in Russia affect how you view this sector?
Yeah, I think that's an excellent question. Clearly, we did not have that in mind when we developed that methodology. As you know, it takes a couple of months to develop a methodology, and that development took all place well ahead of what happened in the last couple of 2 weeks. I think one point to make here is that we do take into account the airline's client probability of default. So clearly, if the clients get downgraded, and then that will have a direct impact also on the rating we have on the lessors, to the extent that they are exposed to those clients. And we also have a jurisdictional risk score, as Michel outlined before, where we do differentiate where those planes or where the equipment is located. And we do make certain assumptions about the recovery times, which then will affect the anchor rating. So in the case of Russia, we would have had already in the methodology a quite long recovery time, and also that assessment would then have affected any lesser heavily rated one that had an outsized exposure to that country. So we would have captured that. And then clearly, if collateral values fall, then again, that would either be captured by us revaluing some of the equipment that we see generally in that industry, or by basically scrutinizing the leverage ratios and other leverage metrics of the affected companies. So we are able to reflect those events, but clearly a large-scale nationalization of the size of 10 billion worth of equipment, that would be something that we clearly would be able to capture with this methodology, but bearing in mind that we also have the ability to make qualitative adjustments at the end for transitory situations. And so we may also then choose upon detailed analysis of the individual circumstances of the company, then to make, if necessary, additional adjustments here. So I think the methodology gives us enough room to reflect those changes. And we also already put out a piece actually on Monday, which sort of goes through the more detailed aspects of the situation in Russia. It's an analytical piece, not a methodology piece. So people who are interested can download that from our website.
Yeah, excellent. I wanted also to ask about the impact, again, very, very broad question, I guess an open question, which is the impact, again, on this sector, the impact of rising interest rates. Now, clearly what's happening in Russia may or may not have an impact on the conduct of international monetary policy. So the trajectory that we may have been expecting prior to the escalation and the invasion may actually be somewhat nuanced. But generally speaking, how do interest rates play into this story?
Yeah, I think the point about interest rates is that the starting point here is that we do not have absolute benchmarks here in terms of interest cover and cash flow and so forth. So we do look at the relative positions of the companies. And I think it's fair to point out that even if you do a 10-year analysis here on the sector, that you would have picked a period of 10 years of very low and very advantageous financing conditions, which for finance companies is quite a key profitability factor. So if interest rates rise, and they already started rising before the Russia events, and so we have this additional increase now in risk premium, then that is clearly a concern for the finance company industry in general, because access to that, not necessarily cheap, but well priced and also sizable bond financing is important. So we would look very carefully here, obviously, at the liquidity position of those companies. And what's noteworthy here is that at the moment, at least, we have very little reliance on short-term funding in that industry. And that's, I guess, a difference to previous episodes. And it is then really a question of having essentially a credible funding refinancing strategies in place. We've seen during the COVID crisis, there has already been quite a bit of consolidation in that industry, which I think reflects some of these necessities. And what we really expect companies to do in these situations is to stay close to the industry benchmarks, and that essentially means that they continue to have access to market-based financing.
Yeah.
And so in typical in these situations is the risk is always with the outliers who kind of lag in performance and who may be lagging in leverage as well.
Indeed. Thank you. And I wanted to, perhaps so I can put this to you, Michel, I wanted to move to, you talked about ESG in the presentation, and perhaps focusing more on the environmental aspects of this. I mentioned the E aspect specifically because there's clearly been a lot of focus in recent years on the environmental performance of aircraft, with regards to things like sustainable jet fuel, and lots of R&D going to that aspect. And of course, within the European Union, we have this rising tide of regulation, which is basically going to force disclosure, etc. I mean, by all means, talk about ESG generally, but in a nutshell, can you just talk about how you view the environmental aspects, perhaps in some more detail?
Yeah, of course. Okay. So basically, ESG is an increasing requirement for the lessor industry, coming basically from two sides. First, the airlines. Airlines are getting more and more picky in terms of aircraft, new generation aircraft, in terms of fuel consumption. So you have this pressure coming from the airlines, also due to the fact that now aircraft lessors are ordering in majority aircraft to OEMs. I think 60% of aircraft orders to OEMs are coming from aircraft lessors now. And the second aspect is lessors are getting also pressure from investors. Investors want to invest. Put ESG criteria quite at the top of their priority list in terms of investment. So for lessors, lessors will definitely drive the ESG revolution in the aviation, being as a key intermediate between OEMs, Airbus, Boeing, and the airlines, and depending also on debt investors, as the aircraft lessors, such a capital-intensive industry is. So aircraft lessors cannot evade the ESG topic, and it will get bigger and bigger.
Yes, indeed, absolutely. Well, Dierk and Michel, there are no further questions at this moment, and so for those of you still watching, we still have time if you want to ask a last-minute question. But while we wait for that, perhaps I can ask you, but perhaps both, or to just give some kind of, call it an outlook, closing statement with regard to this subject. Dierk, do you want to kind of start?
Yeah, of course. Thank you. So I think what we're offering here is, and I think that's really the key point, it's a tailor-made approach for these companies. I think it builds on some of the unique features of this industry that are very hard to replicate in standard bank or corporate methodologies. So we're dealing with companies who have very long-term assets, very valuable long-term assets, and they also tend to have long-term contracts with their clients. So I think that gives a level of cash flow predictability that we typically don't find in corporates. And at the same time, we are focusing on the actual equipment in terms of assessing the balance sheet of these companies, again, which is really looking at the intrinsic value of the equipment. and we're not making any generalizations across all kinds of other equipment that you could put into such a methodology. I think that makes it quite an interesting approach from our end.
Absolutely. Michel, anything to add?
I think as Dierk said, it's a very unique methodology, integrating the ESG factor in the core of the credit risk analysis, and offering a unique kind of risk assessment, starting from the asset assessment, and this is quite unique in the market at the moment in terms of rating methodology.
Very good. On that note, there are no more questions, so let's close the session. Dierk, Michel, thank you so much for your comments and taking us through the methodology and answering those questions. Thank you to you for watching. This will be available on replay on YouTube, but also look out for the comment that Dierk mentioned earlier on the Scope Ratings website, www.scoperatings.com, to see the market commentary. So that's it from us.
Keith, also adding here is that the methodology is still open for comment, so it hasn't been formally adopted yet. So you're also invited to provide your comments through the same website, and we will obviously incorporate those and get back to you on those.
Perfect. Thank you, Dierk. Okay, on that note, thanks a lot. Stay safe, and we'll see you next time. Okay, bye for now.
Thank you, Keith. Bye-bye.